Welcome to The Explainer. Look, today we're doing more than just talking about money. We're actually going to build a complete blueprint for creating wealth. We'll cut through all that confusing financial jargon and give you a clear, actionable plan you can start using like right now. And it all kicks off with a really simple question, one that has to do with your daily routine.
Okay, so what if that coffee you grab every morning didn't just cost you, say, $4.50, but actually cost you over $7,000? It sounds crazy, right? But this question reveals a huge secret about money. See, we all look at the price tag, but we almost always miss the real cost of our small, everyday buys.
Yep, you heard that right. Over $7,600. That's not some made-up number. That is exactly how much you could have in just 10 years if you invested the cost of just 3 of those coffees a week instead of drinking them. It's kind of mind-blowing, and it really shows how the tiniest choices can have an absolutely massive impact on your wealth down the road.
And this whole idea has a name. It's a core economic principle called opportunity cost. It basically means the real price of that coffee isn't just the cash you hand over today. Nope, it's the future growth you're giving up by not investing that money instead. Seriously, getting your head around this one concept is the absolute first key to unlocking your financial future.
All right, so before we jump into the exciting part, growing wealth, we have to build a really strong foundation first. It's like you can't build a skyscraper on sand, right? So step 1 is all about playing rock-solid financial defense.
And let me tell you, the number one threat to that foundation is this super sneaky habit called lifestyle creep. You might also hear it called lifestyle inflation. It is the single biggest reason why, you get a raise at work, but somehow you don't actually feel any richer. It's a real problem. And here's what that trap looks like in action. You get a raise, and almost without even thinking about it, your spending just expands to match it. All of a sudden you're thinking, hey, I could use a better car. Or you're going out for more expensive dinners, buying fancier clothes. Your income goes up, sure, but your spending goes right up with it. Your savings rate stays exactly the same, and you're just stuck on this financial treadmill, running in place.
So, the big question is, how do you break out of this cycle? Well, it all starts with being intentional. First, actually write down your long-term goals. What are you even working for? Second, stop comparing your life to what you see on social media. Just unfollow those accounts that make you feel like you need more. Third, create a budget that actually reflects what's important to you. And the most important rule of all, pay yourself first. This is a game changer. It means you treat your savings like it's the most important bill you have. It's non-negotiable.
And if you need a simple framework, the 50-30-20 rule is incredibly powerful. It's super straightforward. You take your after-tax income. 50% goes to your needs, housing, utilities, the absolute essentials. Then 30% is for your wants, the fun stuff, like dining out and hobbies. And that last 20%, that's your non-negotiable slice that goes straight to savings and paying down debt.
Okay, but hold on. Before you go and invest a single dollar of that money you're saving, you have to build your financial safety net first. Life is just unpredictable. An emergency fund is the thing that turns a potential crisis, like a huge car repair or an unexpected medical bill, into just an inconvenience, a manageable one.
So what's the goal here? You want to aim for about 3 to 6 months of your essential living expenses. And listen, you do not want this money invested in the stock market. You need it somewhere safe, somewhere you can get to it quickly, that's what we call liquid, and ideally earning a little bit of interest. And that makes a high-yield savings account pretty much the perfect place for it.
All right, your defense is solid, you've got a budget, you've got that safety net in place. Now it's time to go on offense. It's time to make your money start working for you.
And the engine that's going to power your financial offense is this force so powerful that people say even Albert Einstein called it the 8th wonder of the world. I'm talking about compound interest. It's just your money making money. And then the money that money made starts making its own money. It's this incredible snowball effect for your wealth. And just look at the results here. It's wild. If you invest just $500 a month, assuming an average market return, the growth just becomes exponential. I mean, after 20 years, it's a really good chunk of change. But look at 40 years. The growth curve goes practically vertical. That consistent saving habit turns into over $1 million. That right there, that's the magic of time.
So the obvious question is, where do you actually put this money to capture that kind of growth? Well, for most people, the answer that even legendary investors like Warren Buffett recommend is surprisingly simple: low-cost index funds. So what is an index fund? Well, it doesn't try to be clever and pick winning stocks to beat the market. Instead, it just aims to be the market. It simply buys a big basket of stocks that represent a whole market index, like the S&P 500. That means you own a tiny piece of the 500 biggest companies in the US. Boom! You get instant diversification without having to do any of the work.
Now that low-cost part is absolutely critical. You want to look for something called the expense ratio, and you want it to be tiny. I mean, look at these numbers, 0.015%. That means you're paying practically nothing in fees, and that's so important because it ensures that all that compounding magic stays in your pocket, working for you, not getting eaten up by some fund manager's salary. Okay, so we've covered defense and we've covered offense. But this final step, this one might be the most important of all. It's not just another tactic, it's a fundamental, complete shift in how you think about earning money and building wealth.
The investor and philosopher Naval Ravikant just nails it with this quote. He says, as long as you're renting out your time for money, whether that's an hourly wage or an annual salary, your income is always going to be capped. Why? Because there are only so many hours in a day you can work.
See, real, true financial freedom comes when you can separate your time from your income. It means owning things, assets, that make money for you without you having to be there. We're talking pieces of businesses, software, media, things that generate revenue on their own, whether you're working, on vacation, or literally fast asleep.
You know, back in the day, building assets like that required a ton of money or a bunch of employees. But today, the most powerful kinds of leverage are what Naval calls permissionless. What does that mean? It means you don't need anyone's approval to get started. You can just learn to code. You can just start creating media, like a podcast or a YouTube channel.
And that's where the incredible power of these new kinds of assets comes from. Think about it. You can write a piece of software once, and it can be sold to millions of people. You can make a video one time, and it can be watched by millions. These things can be copied infinitely for basically zero extra cost. They're like a little army of robots working for you, 24/7.
So let's put it all together. The blueprint is this. First, you build your financial defense. That means a budget that works for you and a solid emergency fund. Second, you launch your offense. You consistently invest in those low-cost index funds and just let the magic of compounding do its thing for years. And finally, the big one. You shift your entire mindset away from just renting out your time to building assets that can scale and work without you. That is the blueprint for financial freedom. So the only real question left is, what asset are you going to start building?